Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Thursday, February 15th, 2024, and this is Blockhead Traders Weekly. In this week's episode, we are going to talk about how to keep the dream alive. Rolling those plays that have been busted until you're right, keep that dice going. And also, when you get into the wheel strategy, we're going to talk about keeping the wheel turning. These are two recent trades which I had to put some more management on today. Wolf is a earnings trade that was busted back at the beginning of February. It was rolled once, and today I rolled it again. We're going to talk a little bit about those mechanics. And then Dollar General was another earnings play that got busted a while back, and I actually ended up getting assigned those shares, and I have been battling back and selling covered calls since then, and I sold yet another round of covered call today, so we're going to talk about those mechanics. But before we hop to that content, I'd like to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You can also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, you can pick this up in an audio-only format wherever you get your podcasts, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. It's just myself, Sprocket888 this week, and it's going to be a quick episode because I'm just going to touch on two ongoing plays that I have. These are plays that haven't reached my profit target yet, and they haven't reached my bailout point where I cut bait and run. So they're in this maintain phase where I kind of put my play on and take it all the way up to expiration. And if I hit my profit targets, wonderful. I hit my bailout, wonderful. If neither of those things happen, then I go for a roll to keep the play going. And so we're going to cover two different types of trades here today. The first one is an earnings play that was busted. Actually, both of these originally started in an earnings trade that was busted. The first one, Wolf, I have not been assigned yet. So it didn't get too far down the rabbit hole to get assigned. The second one, I actually did get assigned, and I've been battling back covered call shares since being assigned. Now, the first one I want to touch on is Wolf, and I'll put a link up above to the episode where we first entered the Wolf trade. And there was a few episodes that we kind of kept tabs on it. But in this week's episode, we're going to kind of see what's the latest in the Wolf saga. Now, as you know, a lot of times when I enter earnings trades, I will enter them as a strangle. And so when we go into earnings, I really try to screen for earnings with really, really, really extended volatility. I really like to see it up as close to the 100th percentile as possible. There's various criteria, which we covered on previous episodes. Go back, find them, earnings trades, and I talk about them all the time. What that allows me to do is put a strike on the call side and a strike on the put side. So I'm basically saying, hey, it's not going to go up crazy and it's not going to go down crazy. I'm going to stay in the middle. And that's easier to do when volatility is really extended because that volatility stretches the expected move out, which gives you a higher probability, well, same probability, but a wider area to kind of land that plane in. To stay in between. And so Wolf was one of those things with just uber high volatility. I went in and I entered it with a strangle. So I sold a call and I sold a put. Now, when earnings comes out, if you're going to breach, you're only going to breach one of those strikes. So ideally you stay in the middle, you close it out for a big profit and you're done in a day. If you're going to breach, you're either going to breach past your call side or you're going to breach below your put side. And whichever way you go, you're going to keep all the profit on the other leg because you can't break both of them from earnings. And so that's what happened with Wolf. Wolf broke to the downside and broke through my strike. Now I had a $30 put, which means I was willing to buy the shares of Wolf for $30 a share. And it went way below that. I can't remember how far down it got after earnings, but I want to say it was in the mid 20s. Since then, it's kind of come back. I think today it was trading around 28, mid 28s. But what happened is right after earnings, all that volatility popped out. and I was able to roll that forward. So I didn't want to get assigned. So on the day of the previous expiration, which was February 2nd, I went ahead and I bought back my calls, which were kind of, or bought back my puts. I'm sorry. I let the calls expire worthless. That was the high side. Bought back my puts, kind of expensive, but I turned around and sold them. And so I got back my intrinsic value. Intrinsic value is the distance from the strike price to the trading price. So for example, it was a $30 strike. I will say, let's say it was at $25 was the stock price. That means those options had $5 of intrinsic value. So time premium is above intrinsic value. Time premium is referred to as extrinsic value. And so I was able to, when I had to buy those puts back, I had to pay $5 plus the time premium left. Now, there wasn't that much time premium in them because it was the day of expiration. And when I turned around and sold the same strike just further out in time, I got that $5 back. So the $5 is a wash. So really all you're doing is trading the time premium. And so the time premium decay on that February 2nd was such that the difference between time premium in the future and now was 35 cents. And that doesn't seem like a ton, and it wasn't really, but it was $35 a contract. Each contract is 100 shares, 35 cents a contract. So it's $35 a contract because each one is 100 shares. I had 4 contracts, so I was able to collect. Okay, I corrected the math there on the table. Sorry, that was incorrect. So I was able to buy or sell those new shares. And now I typically, when I'm rolling, I'll do expiration the week of earnings. So I'll play weeklies there. But once I'm away from earnings, I like to target the monthly expiration strikes. So when I have a busted earnings trade, I will go to the nearest monthly expiration. Sometimes that's the next week, sometimes it's 2 weeks out. So in this case, on February 2nd, I closed out those puts that were deep in the money, and I sold the same strike that expired on February 16th, which was the next monthly expiration. So today, February 15th, which was the day before expiration, I wasn't sure if I get an opportunity tomorrow to roll that forward or what might have been happening. So today I took the opportunity to close those shares that were open. They were 5 cents left of extrinsic value. And I was able to close those out of the February 16th expiration, and I resold the 30 strike in a March expiration because I'm going to roll forward to the next monthly expiration. And so when I rolled those forward, once you factor in the payment that I had to make to close the current ones out, and then the premium that I got to sell the new ones, I was able to pull in an additional $1.50 per contract. So 100 contracts per 100 shares per contract. I had 4 contracts. I basically collected another $600 today, rolling that forward to March. So again, this is just lowering my cost basis should I end up getting assigned. Otherwise, I'm just kind of rolling this out to collect more money and wait to be correct. And so if we look at the premium that I have collected thus far, you take the original 720 from the strangle, the next 140 from that first roll of the put side, and then another 600 for a secondary roll of the put side. I have now totaled collecting $1,460 on this trade. Now, originally that buying power was much less because originally I sold out of the money puts, but now we're in the money, so that buying power has expanded. And so the current buying power consumption here is about $3,700. However, if I take that premium that I have collected and that return on capital, so I use the numerator there as the 3,700, and I put up there 1460 is the actual numerator. The denominator is 3,700. That would come out to be about a 39% return on capital. And so we're just in this rolling mode, and I will wait. So either I will hit my profit targets before expiration, or I will roll at expiration, and then the more premium I collect, the further down my bailout price becomes. So bailout price is always 2 times my credit received. So basically, I have to be on the hook now for 28, 29, 20 loss before I will take that. And so I'll just kind of let that buying power sit there, and I'll keep rolling. And every time I roll it, I will collect more premium, and either I will be right or end up getting assigned the shares potentially. I'll sell calls against them. But it's just this mechanic here of kind of keeping after it. And yes, you weren't right. Yes, you didn't turn the profit on that overnight earnings trade like you wanted, but don't book the loss and walk away because there still are my mechanics there of roll it until you can be right. And like I said, there is a bailout price for me, which is often 2 times the credit received. We didn't hit that on this particular entity, and that's why I'm still kind of in this management. I'm in this limbo land where we haven't gotten to my bailout, but we haven't gotten my take profit. The next one that I want to look at is a wheel trade that I've got going on Dollar General. Now, this one's been going for actually a really long time. And so what we've got here is there was an earnings trade that I played on Dollar General way back in August. And in August, it was again one of those strangles. I fit the really elevated premium. I sold a call and I sold a put. I collected $2.68. So all this is one contract because Dollar General was a bigger underlying. So go ahead and look at this as $268 I collected. Now, earnings didn't really work out on this one. It fell through. It was originally a 142 put. And what I ended up doing was it got so ugly that there wasn't that much premium and the 142 strike wasn't actually available. So I actually had to roll it out in time, and I rolled up the put. So I actually got a little bit more aggressive on where I thought this stock was going, even though I was deep in the money below 142. So I was able to collect another $3 on that move, and I had sold the 145. Shortly after that, maybe about 2 weeks later, that guy I ended up getting assigned. So that was trying to take it to expiration, but it just got so deep in the money, I ended up being assigned at 145. So I bought those shares, 100 of them for $145, and they went into my portfolio. Now, this thing pretty much just kind of had to sit there because it was so deep in the money. I mean, just ridiculously deep in the money that I was holding these shares. Now, once I have these shares, it's a little bit different about your cut bait and run because we are kind of at that 2 times loss, but you are collecting a dividend. And there is some value in those shares to kind of hold them. And so I didn't really want to get rid of this one. I just decided to hold it. And so as we approach December, so next earnings cycle, just before earnings, the volatility was kind of starting to creep up again. And so I was able to sell a covered call at December 8th expiration, which I believe was the earnings week of, for $2. And that allowed me to collect another $200 to kind of chip away at that really steep assignment price that I ended up taking it at. Of course, if I would have gotten assigned at 145, it would have been a wash because I paid 145. So that's why I don't ever put like what the profit here is because my strike, I kept at my assignment price. Now, I could have moved that as my cost basis moves around, but I didn't. And so time went by and we ended up rolling that thing because, well, it expired worthless. So I didn't actually roll it because I let it expire worthless, and then I waited for the premium to come back. Because once earnings comes out, which is what happened there that week of 12/1, is volatility goes poof, gone. And when you're that deep in the money, it's really not worth it to sell a covered call until you either pump up the volatility or you get closer to your strike price. So I treaded water for a while. And finally got around on December 28th, just before the new year. Volatility had kind of pumped up enough, price had pumped up enough that it was time to try to sell another covered call. So stuck with the 145 strike and sold that for $3, collecting another $300. Now, I kind of went out pretty far in time because, like I said, it was kind of deep in the money. I needed to grab some premium, wanted to give it time to get closer to that strike. So I went all the way out to February expiration, which brings me to this week. So tomorrow, those shares were going to expire. That contract was going to expire. I was able to buy that back for 5 cents and then turn around and sell another set for $4.30, which is why you see 425 there. I've subtracted the $5 out to close the the expiration tomorrow, just 1 day early. Now, I went to the next monthly expiration. So I always try to go month to month to expiration and check the premium. So going 1 month out at about a 30 delta, 35 delta for that 145 strike was $430 or $4.30 minus the 5. So now I am out to March expiration here. If I get called away at 145, let's say it rockets up past there. Okay, so what? I get assigned at the 145, which is what I was assigned at originally. So that's a wash. And the premium that I have tallied up here, that ends up being my takeaway from this. So far, if you add up all the premium that you see there on the screen, it totals $14.93 that I've collected, or $1,493. The other way you can look at that is those 100 shares. If this one happens to expire worthless, you can say you can subtract $14.93 off of that 145 strike price, and that's my cost basis. Because if you want to offset it with the premium that you've collected thus far, now all of a sudden you're looking at a much lower cost basis on your shares. So I could end up just holding these shares and keep riding the stock up. But what I like to do is, if the stock does rally, I'm going to try to push that call strike higher and higher before I get assigned, just collecting more and more premium. And then once I start getting above that 145 strike, if I'm able to, now I get to keep my premium and the delta and the strikes of however far I get my strike above 145. And so this is just another strategy that I have out there, and I like to cover it because a lot of times you see videos and you hear about traders buying a particular share of stock, watching it, 10x going up, how many percent, and you think that's the only way that you can play stocks to win at this stuff. There are different strategies out there. The one that I have here is premium selling. It's not as glamorous, but it is something that can absorb blows in the stock price up and down. It doesn't hit you as much on your day-to-day. Yes, you see some red. Yes, it doesn't explode up. You're not going to get a 10x or a 50x or something crazy like that, rocket to the moon. But it is a way where your win probability can go way up. And that can be really good for your trading psychology, your mental health. Sometimes you get into these really volatile names where your portfolio is up huge one day and you're like, yes, very euphoric. And then another day you're down 5%, down 10% on your portfolio, and it can be very draining. I personally find a lot of this premium selling stuff, the type of thing that kind of more is slow. Like, yes, you get your ups and downs, but it's more of a rolling type C, and it's not as violent. And it's very manageable. Like, you get dark days where there's drawdowns, but you still, with the rolls, can collect premium, and it's kind of like you got a little bit of a paycheck still coming in. It's not as pretty because you got a account drawdown. It's something where you can still collect money, rain or shine, if you would. So that brings us to the end of this week's episode. Like I said, go to thetagang.com/Sprocket day to date. You can see all of my trades, the good, the bad, and the ugly. You can go back. I've got trades in there now since 2021, I think might be the first year that I have them. 2021, 2022, 2023, this year. And you can see the win percentages. You can see what was the big winners, the big losers. I put comments in all of my trades. I've had good years. I've had not so good years. And really, this premium selling is the thing that has consistently worked for me. And, if you look in there at some of the performance, my 2024 is 100% this premium selling. 2023, the first half of the year was kind of a mixed strategies, but the second half of the year was all this premium selling. And the probability is there. Now, the huge gains, it's just not there, but that's not what I'm going for. What I would rather have is those consistent profits. And the best thing here is keep the wheels turning, keep the dream alive. You have the ability here with this premium selling to roll until you're right. You have the ability here to take assignment and then turn around and start selling premium against it until you're assigned away and the shares go away. Then you pick another share and you go around that wheel again. That wheel strategy is, sell the puts till you're assigned. Then once you're assigned, sell the calls until you're assigned and you get them called away. Then go out and sell the puts again. And it's just this constant back and forth. And what you're doing is you're capitalizing on that time premium. Premium selling is all about selling the time value in the options, waiting for time to pass, that value to decay, buy them back cheaper, close them out, go sell that time premium again. You're basically the insurance agent for the person that is purchasing those options from you. So we'll keep you posted as we keep going along with these trades. Good luck out there. Hopefully you're finding a strategy that works for you, and hopefully you're finding something that is exciting for you to keep you engaged in the markets. Whatever it is, good luck out there, and remember, think outside the block.